Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm having a conversation with Laurence Parisi, who is the Head of Direct Investment at Trilogy Funds Management. Laurence is going to be talking to us about the risks and opportunities evolving in the commercial property market in 2026. Laurence, it's great to see you.
Likewise, Chris.
Laurence, the themes in property markets, they tend to unfold over longer timeframes than in some other markets perhaps. What were the big themes of 2025 and what's emerging as we head into 2026?
Sure. The biggest theme in 2025, no doubt, was the recovery of the commercial property market in Australia. After a correction period of 2022 to 2024, we saw the re-emergence of transaction volumes in 2025. Everyone from syndicators through to international offshore capital was active again in the market, and that was by far the biggest theme in 2025.
And as we look to 2026, Laurence, talk to me about vacancy rates and where they're likely to peak.
Sure. Somewhat cautious on vacancy rates. Given that extra transaction volume in 25, we saw a little bit of speculative development in 2025 heading into 2026, and that's translated into a higher level of vacancy in the industrial market, albeit well below equilibrium, but that's certainly a theme we need to be mindful of this year.
Laurence, you were just talking about the vacancy rates. 2025 also saw some above average speculative development. What does that mean for landlords? How are things shifting out there?
Need to have a cautious lens, Chris. With that increase in vacancy, need to be mindful of your underwrite assumptions when you're acquiring assets, relatability of an asset, incentives, market rental growth forecasts when looking at new acquisitions, and mindful of working very closely with your existing tenants to ensure that they remain happy and are willing to remain in the assets that they're currently letting.
Yep, so it just comes back to the discipline, it sounds like.
Absolutely.
Laurence, industrial property was one of the hottest asset classes in your space in 2025. A lot of institutional capital flowing into the sector. Talk to me about competition when there's that much money flying around. Does it worry you at all? And then what are the risks and opportunities that come from that?
No, in short, it doesn't worry us. It's nice to have that much focus on the industrial space. It does make acquiring assets somewhat more difficult. However, for us, it's all about remaining disciplined, what you're buying, where you're buying, the quality of the tenant and the income stream that supports that piece of real estate. I think if you stick to the fundamentals, you should be fine through the medium to long term.
Laurence, one of the factors that you just touched on there was properties that are well located. So Trilogy has deliberately targeted such properties across regional and metro adjacent assets rather than competing head to head in that core CBD industrial markets. Talk to me about the characteristics of these types of properties, what makes them attractive, and why do you think they're still being underappreciated?
Fundamentally, they're very similar to the assets that you find in the major metro markets. Quality tenants, modern real estate, new builds, long leases, great rental growth. The fundamentals are all very similar. However, the markets that we have typically focused on are just smaller, and that means that the institutional investors with very large mandates can't deploy the volumes of capital that they would like to in those markets. However, fundamentally, there's absolutely nothing wrong with the real estate that we're buying, and what we've found is that the tenants within the portfolio that we have been very sticky over the long term.
Yeah. Just follow up there, if I may, Laurence. So one of the things I was reading in the notes in preparation for this was just focusing in on that metro adjacent asset. So it's that last mile. So they're very close to the city, but they're not in the city. Is that a key characteristic?
Yeah, absolutely.
Yeah. Laurence, let's turn the theory into practice. So the Darwin acquisition that you recently made, logistics asset, what was it about that deal that made it really attractive, and why is it compelling in today's market?
Yeah, many things. We like Darwin as a market. This was our second acquisition in Darwin. It really is the gateway north of Australia for logistics and defence. The local government have put a lot of time and effort into growing the economy. There's a lot of resource demand. Internationally, defence is very topical at the moment. So ultimately that economy is growing stronger than a lot of the East Coast markets. And if you zero in on the real estate market, demand-supply dynamics are very favourable from a landlord perspective. There's very low risk of it being oversupplied. that then translates into strong rental growth, and that's what we've witnessed in the first acquisition that we acquired in Darwin, and more recently with the modern logistics facility that we've acquired. Similar principles. It's a great tenant who's been in the portfolio previously with us, so we have a great working relationship, long lease, great structured rental growth, and a really strong business model that underpins that asset for the future.
So Laurence, just on that, like most investors wouldn't think about Darwin, I wouldn't have thought, as an investment location. And you talked about the supply and demand dynamic. So is it that supply can't be brought on quickly, and so that what is there is very valuable and targeted by investors? Is that sort of the key to it?
Yeah, that's exactly right, Chris. And also the new supply is hampered by the cost.
Right.
So prohibitively expensive to build in Darwin, which means that you're not going to exhibit speculative development, which means that the equilibrium in the market is maintained. And that works both from a landlord perspective and also from a tenant.
Laurence, you've already mentioned a couple of times having stable and reputable tenants. It's a recurring theme in your strategy. So long-term leases, reputable tenants like you talked about, structured rental reviews. I imagine that's super important in today's market where people want income certainty. So just talk me through how you're thinking about that and how it affects the assets you're willing to own today.
Absolutely, it's consistent with what we've done previously and what we're going to do into the future. There's a bit of a risk-off play in the commercial property market at the moment, so that there's a reversion back to long lease real estate, which fits well with our portfolio and our methodology of acquiring assets and identifying assets, and then it will ultimately translate into solid returns for our investors.
Laurence, let's talk e-commerce. It continues to grow exponentially, really, gobbling up market share of retail spend in Australia. How is that translating into real on-the-ground demand for industrial space? And talk to me about some of the elements. So I noticed height was something that's important.
Yep.
What does that mean in terms of your world?
Sure. Well, this really emerged pre and post-COVID. Nationally, online sales represent about 13% in Australia, which still lags a lot of the developed countries in the world. So we see this as a structural tailwind for the industrial market. As online sales grow, the demand for industrial sheds is going to continue to grow. What that means ultimately for a landlord or a tenant is you need to focus on larger, more modern facilities, higher clear spans, the ability to move more parcels through a facility more often, and also the emergence of AI and tech to help with that as well.
So just doubling down there, that automation piece, how important is it for clients to be able to, or tenants to be able to walk in, look around and go, yep, we can automate all that, we can move our packages through this facility? Is that critical these days?
Yes, it is. It's becoming more critical as there's more pricing pressure on moving parcels around and more stress to get parcels where they need to be quicker. Then the automation and AI and tech has really come to the fore.
So just taking it back, do you have people within Trilogy that go and assess these properties and determine whether they're suitable or already have the automation capabilities?
In short, yes, that's the responsibility of the property team to do that.
Laurence, just pulling on a thread there, re-automation. It seems we've shifted from just in time, which was the Japanese philosophy, to now just in case. How are you seeing the move from those two philosophies play out in your space? What are the strategies, and then how does it impact the assets that you might invest in?
Yep. So that's had a big impact on the demand for industrial space across the country post-COVID, with retailers, wholesalers and logistics firms requiring more space to hold more assets, and ultimately what that's translated in is greater demand for industrial. However, with the emergence of tech and AI, that's also helping the facilitation of moving parcels across the country. What that means practically at an on-the-ground basis is more modern facilities, higher, more clear span, yard area for throughput to make the facilities more efficient.
Like the rest of the world, mate, it seems like everything's getting more automated, more efficient, more AI, more everything.
Sure is.
Laurence, it's always a pleasure catching up with you.
Likewise,
Thank you so much for taking us through that. Appreciate your insights.
Thank you. Cheers.
If you enjoyed that interview, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.